right, let's work through some example problems from the Chapter 4 concepts. Chapter 4 is working through the end of the accounting cycle, kind of the end of preparing the financial statements and then doing the closing process to get ready for the new accounting period. So what we have here on the left is our first exercise we're going to work together, and on the right are the solutions. So taking a look at the problem, these are the accounts and year-end adjusted balances of Cruise Company as of December 31st. This is the adjusted trial balance, right? These are the adjusted balances. So that right away tells me that these account balances reflect all of the normal day-to-day business transactions throughout the year. They've already been recorded. Account balances have been updated. And all of the adjusting entries that we just learned in the previous chapter, those have all been recorded and posted to the accounts. So these balances are all adjusted. Essentially what they're ready for is preparing the financial statements, which this problem doesn't have us doing that. What this problem is going to have us do is the step after the financial statements were prepared, and that is the closing entry process. There are 4 closing entries that we need to accomplish. We need to close out only the temporary accounts. Okay, so the temporary accounts, remember, are the revenues, the expenses, and the withdrawals account. The 4 closing entries are in a specific order. We start with the closing out the revenue account first. So looking at the balance in the revenue account, the adjusted balance is a $44,000 credit. To close out that credit balance, I need to debit this account. So my first closing entry is going to debit the service revenue account for $44,000. I am going to transfer the total amount of revenues recorded in that account over to this temporary account income summary. So I'm going to debit the service revenue account, which zeroes out that account, and I've transferred the revenues into income summary. The second closing entry is going to close out the expenses. So looking at my adjusted trial balance here, I have 1, 2, 3, 4, 5 expense account balances that all need to be closed out. These balances are all debit balances. So to close those out, to get rid of those balances, I need to credit each account for whatever its balance is. So I'm going to credit each expense account for its balance. Total of all of my expense balances is $33,100. I am going to debit the total of all my expenses into income summary. So what I have done now in those first 2 closing entries is if I were to see this in, excuse my scribble, not very good with the drawing with a mouse, but if this is my income summary account, that first closing entry credited this account for $44,000. My second closing entry debited it for $33,100. I credited this account for the amount of revenues, and I debited this account for the amount of expenses. The difference between the revenues I credit in there and the expenses I debit in there will leave me with a balance in this account. So right now the balance in this account is the difference between my $44,000 credit and my debited $33,100. The difference between those two is $10,900. So after my first 2 closing entries, I am left with a credit balance in this account, and that is the amount of my net income for the year. So the income summary account just summarized my net income. My third closing entry now is going to be to close the balance in the income summary account. So if this is sitting there with a credit balance, to get rid of that credit balance, I need to debit that account. So I'm going to debit it at 10.9, and I'm going to transfer the amount of my net income into the owner's capital. I'm crediting owner's capital for the amount of net income. What has now happened in these first 3 closing entries is that all of the revenue accounts will be zero balances. All the expense accounts will be zero balances. And now income summary is also a zero balance. I have cleared that balance out of there. Total amount of revenues and expenses, i.e. net income, is now permanently recorded in the owner's capital account. 3 of the 4 closing entries are accomplished. The last closing entry is going to close out the withdrawals. It is sitting there with the debit balance. To get rid of that debit balance, I am going to credit the withdrawal account. Credit that account to zero it out, and I'm going to transfer the amount of withdrawals into the owner's capital with a debit. That debit will decrease owner's capital for the amount that the owner withdrew during the period. Big picture, what the closing entries have accomplished is all of the temporary accounts, withdrawals, revenues, and expenses, they're all zero. All of their balances have now been transferred into the owner's capital account. Owner's capital was increased by the amount of net income, decreased by how much of those profits the owner withdrew during the period. So if I were to prepare a post-closing trial balance, essentially there would be nothing left other than the permanent accounts, assets, cash, supplies, prepaid insurance, equipment, and the contra asset account. And it looks like this was a very lucky business that didn't have any liabilities. And now the owner's capital account, which had ended the year with $47,600, we then increased that $47,600 $10,900 for the amount of income. And then we decrease that capital account for the amount of withdrawals, leaving it with an ending balance of $51,500. Okay. So my post-closing trial balance is a lot smaller than my adjusted trial balance, because whereas before all of these amounts that affected the owner's equity were split out across owner's capital, withdrawals, revenues, and expenses. But now at the end of the closing process, those temporary account balances are all now wrapped up into that one owner's capital account. All right, let's do another problem very similar, but this one's going to have us preparing the financial statements. Okay, so we're working with the Thibault, however they want to pronounce it, construction on December 31st of the current year. The owner has invested $5,000 cash in the business during the year, and the owner's capital account balance was $121,400 on December 31st of the prior year. Okay, so end of last year, the owner's capital balance was $121,400. If I'm to look at where we ended this year with in owner's capital, owner's capital balance ended this year with $126,400. It began the year with $121,400. So I can start to make some inferences here based off of what they've told me. Remember, the only thing that is affecting the owner's capital account directly are owner investments. So if last year's ending increased to this year's ending, the difference between those two has to be the amount of owner investments during the year. So sorry if I do my math here correctly. Ended this year with $126,400, ended last year with $121,400. I can interpret this to tell me that the owner must have invested $5,000 during the year. Okay, so I had to do a little investigative work here before I get started, but we'll remember that. So they want us to prepare the income statement, statement of owner's equity for the current year, and the classified balance sheet. Okay, the classified balance sheet is a new concept in this chapter. We're classifying assets and liabilities into current and non-current categories. Pretty simple. We'll talk about it when we get there. So the first thing, income statement. Remember, the income statement is reporting the profits for a period of time. So we're reporting the revenues and expenses for the year ended December 31st. So looking here at my adjusted trial balance, these account balances have all the normal day-to-day transactions recorded in them, as well as the adjusting entries. So everything that happened during this accounting period is reflected in these account balances. Looks like I have 3 revenue accounts. So on my income statement, in my revenue section, I have 3 types of revenues to report. Total revenues earned for the year, 115.1. Then I have 9 different expense accounts. I'm going to list all those out under my expense section. Total expenses of 110.8. Revenues earned during the year, less expenses incurred. I'm left with a net income of 4,300. All right, so we reported on the company's profitability. Now let's report to the owner, to the investors, the owners, how the company's equity looks to them, their share of the company. So here is the construction statement of owner's equity. This is reporting the changes in equity from the beginning to the end of the year. So remember, we started this year with 121.4 in owner's capital. Last year's ending became this year's beginning. We figured out that because we ended this year with a larger capital balance, and the only thing that is directly recorded into the owner's capital are investments, we inferred that the owner must have invested $5,000 during the year. Okay. So what also increased owner's capital during the year? Owner's equity was increased by the amount of revenues less expenses, the amount of profits. Well, I've already summarized it in my income statement, so I just am going to bring net income from my income statement right down here into my statement of owner's equity. Come to a little subtotal, then I'm going to subtract out how much the owner withdrew during the period. And the owner withdrew $13,000. So I'm going to subtract that from my subtotal to calculate the owner's ending capital. Hey, this does not agree with what I'm reporting here for owner's capital in the general ledger, because currently all of the other things that affected owner's equity are recorded in different equity accounts. Okay, so that's why this number doesn't agree with the capital in the general ledger yet. All right, so we've reported profits. We've reported the effect of the transactions on the owner's equity for the year. Now let's prepare the classified balance sheet. Okay. So remember, the balance sheet is just reporting all the assets, liabilities on one day in time, not a period of time, one day. So this is as of the last day of the accounting period. I'm going to classify the assets as to whether they are current or non-current. Current assets are going to be all of the company's assets that they intend to use up or convert to cash within the next year. And for purposes of where we are in our understanding of the assets, pretty much all of the assets we've worked with are current except for property, plant, and equipment. Okay, property, plant, and equipment the company buys with the intent to hold on to them and use them for the current year and beyond. So they are considered long-term. So we are going to break out our current assets, cash, supplies, prepaid insurance, come to a subtotal. We're going to separate those out from our property, plant, and equipment. Okay, so we've got to report the asset along with its contra asset account. Equipment originally cost us $40,000. We have since depreciated or expensed $20,000 of it. It still has a $20,000 asset value. Building we originally purchased for $150,000. It has an accumulated depreciation of $50,000. It still has a current value of $100,000 as of December 31st. And land is the one long-term asset account we don't depreciate because we never use up the value of land. Land has an unlimited life, whereas these other assets, equipment and building, they have a limited life. They will wear out eventually and need to be replaced. Okay, so our balance sheet has broken out our current assets from our long-term assets. We're going to do the same thing with our liabilities. Okay, we're going to break out liabilities into current and non-current, current and long-term. Again, the same rule of thumb. Any liability that has to be paid within the next year is considered current. We do have one liability here in the adjusted trial balance that has told us that it's long-term. This note payable does not have to be paid within the next year. It has to be paid sometime beyond the next year. So we're going to break that out separately from those liabilities that are due within the next year. And the good thing about the classified balance sheet is equity is unaffected. We will bring our ending owner's equity from our statement of owner's equity right down into our balance sheet. Okay. So really conceptually, the other financial reports are the same. Classified balance sheet, we're just classifying assets into current and non-current, liabilities into current and long-term. And the rule of thumb between whether something is current or not is typically 1 year. Okay, so now that we have the financial statements prepared, we are done reporting on this accounting period, which means we need to get the accounts ready to start recording the next accounting period transactions. That is going to be the closing process. Okay. So the closing process is going to close out our revenues first. We have 3 revenue accounts to close out. They all have credit balances. So to get rid of those credit balances, we are going to debit all the revenue accounts, and we are going to transfer the total of all our revenues temporarily into this income summary account. After that first closing entry, the income summary account is sitting there with a credit balance of $115,100. All the revenue account balances will now be 0. My second closing entry is going to close out all of these expense accounts. We got a whole bunch of them. To close out the expense accounts, which have debit balances, we need to credit each of the expense accounts. Total dollar amount of expenses that we are closing is $110,800. We are going to temporarily record total expenses in the income summary account. So after those first 2 closing entries, revenues and expenses are 0. Currently, my income summary account was credited for $115,100, and then I debited it for $110,800, which would have left it with a credit balance of $4,300. The credits in there were greater than the debits, leaving it with a credit balance. To get rid of that credit balance, I'm going to debit that account. So I'm going to debit income summary, and I'm going to transfer the amount of my net income into my owner's capital account. That increases owner's capital for the amount of my income for the year. My last closing entry is going to close out the withdrawals. The withdrawal account has a 0 balance, has a $13,000 balance. I want to get it to 0. I want to close it out. So to close out that debit balance, I'm going to credit the withdrawals account, and I'm going to directly transfer the amount of withdrawals into the owner's capital account with a debit, decreasing that account balance. By the time I get done with these closing entries, all of my revenue accounts will be 0, my expense accounts will be 0, and my withdrawal accounts will be 0. All of those amounts will now be recorded into the owner's capital account. Essentially what I've now done is caught the accounts up to what I'm reporting for ending capital at the end of the year. Increased by the amount of investments, increased by net income, decreased by withdrawals, ending owner's capital balance $117,700. Okay. So now let's just stop really quick and think about what we've accomplished by going through the closing process. when I start recording the new accounting period's revenues, expenses, and withdrawals, the accounts will be starting the new accounting period with 0, so that all of the amounts recorded in those in the upcoming accounting period reflect revenues and expenses and withdrawals only for that accounting period. That makes it super easy when I get to the end of the new accounting period and I'm preparing financial reports. Makes it super easy to go through the process of preparing my financial statements. Hopefully this helps with the chapter concepts. Now time to do your homework.